To welcome everyone to Investor Roundtable. We have some great panelists here, and we might as well start with introducing you, Danielle. How are you doing?
I'm good. As I mentioned, I'm in Halifax, in case you didn't catch that yet.
Yeah, we're all jealous. So tell us a little bit about Sandpiper VC and a little bit about your background in the industry.
Sure. I mean, a lot of people don't know about Sandpiper yet. It's pretty new, launched during COVID. Um, my flight to Newfoundland to meet my team was canceled the week COVID kind of outbroke. So, I came out here in quarantine and met the team through that process. And, women, it's very much focused on women entrepreneurs. The entire team are accredited women investors that actually came together through CDL Atlantic. And so bringing them together, structuring out this fund, beginning to get into the kind of active stages of investing now. And so I can definitely share more details about what we're looking for a national focus, but coming from the Atlantic, all our limited partners are from the Atlantic at this point. And then overall, my background kind of started, I did a master's out here at Dal, but I went to Waterloo because there wasn't really a tech before. And so ended up in Waterloo, Kitchener, working at Communitech, working on a clean tech company, then started on the investment side through Angel Networks and Market Readiness, OCE's early stage investment fund, as well as a diversity fund called Dreammaker Ventures that's now well recognized for their Black Innovation Fellowship. So kind of seen a lot of the tech scene in Toronto, Kitchener, Waterloo, and now really building out what we're looking at across the Atlantic, which is a lot to discover and a good time to discover it.
Yeah, and we've known each other for a while, and some of your time with OCE and other companies, and we've talked about your time at Fierce Founders and all that other stuff. We don't have to get into it now, but I just dropped those for people who are interested and know those things. Stuart, over to you. Tell us about you and Pycap.
Sure. Okay. So Stuart Brown, I'm the CEO of Pycap Venture Partners, which is a venture capital firm located in downtown Toronto. Our company is not just a VC fund, but we also do consulting services for early stage tech companies. I'm actually acting as the interim CFO for three tech companies currently. We have about 10 companies in our portfolio in total. And in addition to all of that, we run educational programs. So I teach at the Scaleups School of Business. I teach their Master of Finance program as well as their MBA program. And I teach everything related to venture capital and private equity. And in addition to that, I teach at U of T School of Continuing Studies courses on entrepreneurship, corporate finance, venture capital, private equity, all of that fun stuff.
Fantastic. And Alex, tell us a little bit about you and Equivesto.
Yeah, so I'm one of the co-founders of Equivesto. Equivesto is a new equity crowdfunding platform operating in Canada, and essentially we help companies raise between 25,000 and 1.5 million from their own extended community. And so the general public can invest in businesses on the platform starting at as little as $100.
And anybody can invest?
Yeah, so anyone who is basically a Canadian or is living in one of the 4 provinces in which we operate, so British Columbia, Alberta, Ontario, and Nova Scotia are the 4 provinces where people can live, and as long as they're 18 or over.
And that's great. And we're going to be delving a little bit into the differences between, VC funding and equity crowdfunding in a little bit. And I just want to talk to the people who are here. We want your questions. So if you have questions for the panelists, put them in the chat room, put them in the Q&A window, and we'll get them. I have a bunch of questions here, but we'd love to know a little bit about what you're up to and what kind of questions you have for our investor panel. So with that, Danielle, what types of conversations should entrepreneurs and investors be having that, they're currently not having?
It's a good question, actually. I like it because I feel like I'm saying this on a daily basis. And so, well, number one, people are having different conversations now. So I'll give some COVID context to this as well, because fundamentally we're not able to network in the same way. There's not that haphazard meeting. The amount of events that were taking place, I mean, you and I were running into each other on a weekly basis. So I think that has hurt the founders more than anyone, because we've been networking in the ecosystem for a long time, so we know a lot of the people and we can reach out and we have those warm intros. But for those of people who don't have access, that access is even more limited. And so I think that there's a lot to be said for doing that cold outreach on LinkedIn and managing the ways that you can find new people in this time, and then leveraging those kind of one-on-ones and those conversations to actually connect with people who you target and will be the right fit for you. So what I would say in terms of conversations that founders should be having that they're not having are to be a bit bolder around who they're reaching out to, who they know will be the right fit for them, doing their research, and actually pulling in their network now on a tangible and tactical way, because otherwise they're going to fall behind. And I don't think that networking style is ever coming back.
Yeah, I think it's harder to build community now in a lot of ways, and I hope you're wrong with that networking style not coming back, because I missed the live events that Toronto Starts used to be a big part of here in the city. But we adjust, and I think there's energy in the crowd that we all miss. So hopefully we'll find a replacement for that.
Yeah, well, I'll have less FOMO out here if you guys aren't doing those. So
yeah, fair enough.
But I would say on a positive note that the world is more your oyster because everyone is virtual. So if you're reaching out anyway, why are you reaching only within your region or within your borders? So I would say reach further and research further and build your network further, and don't be shy.
Yeah, I agree. I think we were limited to mostly the Toronto area and Ontario, but now we can help anybody. Why limit ourselves? So it's the same type of thing. We have people coming in from all over the place. So I agree.
Yeah, we're definitely seeing that at Equivesto. It's not just entrepreneurs and investors from the same area getting together. There's a lot of involvement across provinces and everything. So a lot of people are just trying to help support and connect as best they can during this scenario.
And I hope you're wrong, Melissa, in the chat room. I hope you're wrong. Stuart, what are fund cycles, and why does it matter where a fund is in their cycle to startups looking for investment?
Well, that's a great question, and one of the main reasons why I like it so much is that it kind of gets the entrepreneurs out of their own head and into the head of these fund managers. Because there's a lot of, I guess, love-hate sort of thing. I wouldn't say from VCs to entrepreneurs, but I think the other way around, from the entrepreneurs to the VCs, because they see us. I mean, correct me if I'm wrong, entrepreneurs out there, but there's a tendency for entrepreneurs to view venture capitalists as people who are sitting on a pile of money that they could do whatever they want with, and they're just choosing not to invest in you because they don't feel like it.
But that summarizes you perfectly, Stuart, doesn't it? You've just got millions and millions of dollars behind you.
Oh, yeah. We have money fights, so we just chuck money at each other. It's kind of like a food fight. No, I wish it was like that. It's not like that at all. So imagine, obviously we're in a situation where it's very difficult to raise money. And for startups in particular, because the risk of investing in a startup is inherently quite high. But also when we're in an economic situation where there's a ton of risk, that makes investors want to do what we call like a flight to security, like investing in gold or the US dollar. If you think that's a safer investment, who knows right now with the election and what have you. And so it's difficult for VCs even to raise money for their own funds, whether it's from the government or from ultra high net worth individuals, because venture capital funds are seen as risky because we make risky investments into startups. So when we talk about fund cycles, there's different stages of the life of a fund manager. And the role and the job of a fund manager actually changes quite a bit. So when they first put the fund together and creating all of the marketing documents, they go out and they start soliciting investors to put money into the fund. So then they're in this like salesy kind of capital raising mode where they're meeting with their investors and they're doing the dog and pony show and the song and dance, getting their derriere served to them on a silver platter type thing, just like you entrepreneurs are when you pitch VCs. And then once they're able to secure the funding, then the role of the VC turns into that of an investor, where they look for deal flow, they perform due diligence, and they deploy capital. And they try to deploy capital as fast as possible because money that's sitting in the bank is not generating a return because it's just sitting in a checking or savings account. So they need to invest in things as fast as possible to increase their internal rate of return as soon as they can. And then once all the capital is deployed, then of course they have no money left to invest. So pitching a VC that has no capital obviously is not the right time. Then the role of that fund manager changes from an investor to almost like a manager of a portfolio or even an entrepreneur themselves in a certain way. Because one of the things that defines a VC as opposed to like a hedge fund manager or a mutual fund manager is that VCs actively get involved in the portfolio companies that they invest in. So then they take on the role of an advisor to the companies, or they'll be a board member or whatever. And then they try to grow the companies as fast as possible with the entrepreneurs and try to get an exit. And once they exit all of their companies, the cycle continues and they go back into fundraising mode again. And they'll be raising the fund number 2 or number 3, and then the cycle kind of continues.
Yeah, that's great. I think people need to really understand when you're going for investment where the fund is in the cycle. So, Alex, what do you think comes first for a startup? Community, traction, or funding?
That's a good question. I think it depends on the type of business the startup is and what the startup's goals are. I think building a community is something that you can do regardless of whether you're actually having a product yet. You can post online and start getting people excited in what you're doing at any time, sort of no matter what's going on. So that sort of creates opportunity for you to be sort of working on something external before you're even able to go and get capital. I think when you look at investors, even equity crowdfunding and the stages that companies need to be at in order to successfully raise capital, people usually want to see at least some traction. They want to see that the entrepreneurs and the founders have done some work already to sort of prove out the concept and make sure that everything's working properly before they're going to toss in, millions of dollars. I can't speak for the VCs on the panel. I'm sure they invest on ideas sight unseen, but for everyone else, we like to see a little bit of what you're actually trying to make. And so in that sort of scenario, you can be building the community sort of anytime. Then you can use the community to demonstrate some traction, some interest in your product. And then that's when you can go out to get funding. Specifically with equity crowdfunding, having a community that you've already built becomes a massive asset. If you're trying to convince the general population, for hundreds of people to give you $100 each, if you already have a community of 600 people who know about what you're doing, they've been following you for several weeks, months, or even years, and they're excited about your business and what change you're trying to create in the world or in your space, they're already ready and primed to potentially become your seed investors. So that's really an opportunity that you can start building that social following for free, essentially, from day one.
And we have our first question here in the chat room from Carl. And it's a little out of the blue, so we'll see how it goes. Carl, just recently, a new and unlaunched instant coffee brand launched out of the USA, and they've raised 50 million via VC. Products are now being privately consumer tested and won't be available to 2021. His question based on this is, how does a startup raise that kind of money in the food and beverage space?
I could, Danielle, do you want to answer that, or should I?
I mean, I certainly don't invest in the food and beverage space, so I wouldn't speak to it directly. I could speak to it in terms of like a few groups that I know support food and beverage, but I'd prefer if you have some specific details you can advise.
Yeah, I would say that VCs generally, in my opinion, you're barking up the wrong tree if you're looking for VC financing, especially in Canada. VCs prefer to invest in technology, and then I would take that one step further and say that the preference in technology is software. I mean, there are some VCs out there that might invest in hardware, or they might invest in life sciences, but it's really unlikely they would invest in a food and beverage service. I think you would be a lot better served speaking with Alex and exploring some crowdfunding potential with that.
It's funny you mentioned that because there is a company, Carl, called Stirs Brands that is raising. They are an instant coffee company. They are raising on Equivesto right now, and they have some pretty fantastic products. So maybe people should check them out. I think Carl asked a follow-up question saying he was just curious, wondering how did something like that, a company like that, raise 50 million through VCs on their first MVP in the United States. And to be honest, in that sort of situation, I would probably say they would have a very strong personal relationship, most likely with the VC who operates in that space. They could be a 2 or 3 time successful entrepreneur who might have worked with this VC before inside the food and beverage space, especially $50 million on an MVP. Like, we hear stories about people walking into a VC's office in Silicon Valley and getting 10 million, off of a pitch deck, but that's like sort of unicorn, magical fairyland stuff when it comes to Canada. So hearing 50 million off an MVP is, I don't know, maybe it's the VC's brother or something. I can purely speculative, but that's a massive amount of money to raise off just an MVP.
Yeah, I'm not even sure if that's real. Like, you got to kind of take these stories with a grain of salt. I mean, to me, it doesn't really sound that realistic that someone put $50 million into an MVP, but that's just my perspective.
Especially in the instant coffee space, for example, there's already many large key players. You're going up against like Nestle and like all these other like giants of industry. And if you're getting 50 million from the VC, unless they're buying it outright, the value of the company has got to be at least, okay, let's say they're buying 70%. It's at least 70 million off an MVP. Like, what kind of sales do you have to earn? Yeah, it's, yeah.
And not only that, but to take that thought one step further, VCs want to get a 10x return within 4 years. So that means that if it's $70 million based on an MVP, that means you have to grow it to $700 million within 4 years. And that, like, honestly, the math just, it doesn't really compute, to be honest. Maybe there's something I'm clearly missing here, but yeah. Anyways.
Yeah, and I would agree, like, these exceptional cases don't really help people learn about what their experience is going to be like pitching to VCs, especially not Canadian VCs. So, part of, I think, the benefit of these type of roundtables and panels is to say, well, this is what we're looking for, and this is what we know, and this is what we've been seeing, and this is what we've seen be successful here. So those are at least tangible ways to move forward and practical opportunities that you have access to.
Yeah.
You go for the gold, but
sorry, Danielle, don't mean to interrupt you. I'm seeing in the chat, Melissa had posted that Super Coffee is potentially the company, and their valuation was 200 million with that $50 million raise, which is like, it's in Bloomberg.
And are you sure it was a VC and not a private equity investor? That's another thing worth
So
considering.
we can move on, but I just did a quick glance through the article here while we were all chatting. Looks like they got some attention via somebody from Shark Tank. In 2016, their sales tripled, peaking at like 26 million a year. So they didn't have nothing when they got this funding. So it's just anyway, we'll talk about.
Yeah, this is like winning.
Yeah, they had sales of over 26
More to
million.
Danielle's point. Yeah, I don't think it's helpful.
So anyway,
so not quite an MVP.
Yeah, if that's what it is, and who knows? But
right.
That's a good lead into, we're now 7+ months into COVID. What is the current state of funding in Canada? We'll start with you, Danielle.
Well, I mean, it certainly took a break. People had to kind of rekindle their portfolio companies, support them with pivots. There were a whole host of challenges relating directly to COVID and specific companies, as well as ones that certainly did well and took off given their tech focus and the fact that, so much was taking place online. You can do manual processes. So there were some opportunities for investment. And now, given kind of a level set of the post kind of COVID chaos, a lot of investors had to come to terms with the fact that they can't do things in the way they used to. They couldn't meet founders face to face, do all of the coffees, do all of the networking. There were a few that kind of immediately were like, yes, we'll meet virtually, we'll chat, we'll invest, we're still completely active. And they made a point to publicize that. And others that took a few months, but eventually adapted because they have, active funds, they have money to deploy, and they've allocated that for a certain deployment period. So it's actually a good time for many investors to deploy that capital in new technologies that can service the now COVID world. So what I've been seeing from investors on a VC level is that re-engagement and that activity and that adaptation to the current state over time. Of course, it took a few months. With angels, it's a bit of a different story because people are investing their own money. So they don't necessarily have the same capital. They don't necessarily have the same confidence in the markets. There's been so much flux. So there's some who have taken a step back and are concerned. And there are some that say, I actually don't trust the stock market anymore because it's so volatile. And I'm seeing other markets in technology and early stage investing where I can actually provide support to, great entrepreneurs who are going to change the world, and I want to see them succeed, as well as the opportunity to get some investing dollars in a market that isn't aligned to the stock market and therefore could succeed where there's been challenges for their money. So I'm seeing a lot of different angles, but I definitely think there's still active investors, there's still that activity taking place, and that it's now at a point where it's adapted to not being able to meet with people in the same way, do due diligence in the same way, and actively engage in the ecosystem in the same way. You're on mute.
Anyone else want to jump in on that?
I'm happy to. Oh, sorry. Go ahead, Stuart.
No, you go ahead.
I was going to say, yeah, seeing something similar with crowdfunding. Everyone's just sort of making that shift, and the fact that investments in private companies don't have that constant volatility and that huge swings in prices like you see in the market, even though they are higher risk, it does save you a little bit from that heart attack potentially in the morning when it's like, oh, the market's just tanked, and you're like, well, that's gone terribly. With the smaller businesses, they are definitely higher risk, but you're in a situation where, the valuation is set when you invested, and then the next valuation is going to come out whenever they have the next round, or, you can sort of track the progress of the business from the investor updates, but it's not that same sort of nonstop fear and sort of pull to react immediately and sell.
Stuart, anything?
Yeah, well, I mean, I definitely agree with everything that's been said so far in regards to this question. I just wanted to add a couple of interesting points. So Q2 of 2020, to everyone's surprise, was actually the biggest second quarter of invested capital by VCs in history. There was about 1.7 billion invested, and that was like right in the heart of COVID. So, just it's keep in mind that this, like most of the investments that were made, were put into companies that the VCs already had in their portfolios. So well-performing assets, and that they wanted to kind of support. A lot of these VCs probably had capital that they needed to get rid of, meaning like they needed to, like I said, get.
And
I'll just talk
Get out of
until
the bank account into
there's
something damage of the pandemic. And but definitely some things that I. What's that? My.
yeah,
Do you guys
cut out
hear
for a
me?
bit
Hello?
there. You
yeah.
cut out for a bit there.
Oh, okay. I might have to change laptops if this isn't working. But yeah. So I was just saying that VCs that I've noticed and worked with, and myself included, we're looking for companies that are less risky. So that means that companies that have a more proven business model. I was recently interviewed on this Phoenix radio station in regards to my perspective, like how can entrepreneurs raise money during the pandemic, or what they should do. And my advice to them was to really focus on just generating revenue. I mean, as obvious as that might sound, there tends to be a lot of companies that are so hyper focused on raising VC money to help them kind of weather the storm or survive. I think now is definitely the time to really work on your business model and try to bring in revenue any way that you can. Because at the end of the day, that's what VCs want to see anyways. And I'm sure just like crowdfunding, like it's easier for people to invest in something that's already working as opposed to putting their money into an entrepreneur so that entrepreneur can test their idea out. So I just wanted to kind of throw that out there for some
Definitely
consideration.
And as a result of COVID, what other things have changed? What when you as a VC or as an investor, what are you looking for? Obviously, you're looking for more revenue, and you're taking less risk. But is there other things you're looking for that are different?
Yeah, well, Danielle touched on this. She mentioned how company like we're looking for entrepreneurs that have a COVID or pandemic plan, like a way not just to survive, but to turn the pandemic into an opportunity, and basically, what an entrepreneur should do, and that's finding problems that are existing out there in the market and creating solutions for them. And considering during an economic crisis and a pandemic, there's no better opportunity to find problems that are out there. It's the perfect opportunity for entrepreneurs to take inventory of whatever resources and skill sets they have and consider making an iterative change or a pivot to really focus on what they could do to kind of help people in the new normal, if you will. But of course, not doing it in a way that once the pandemic is over, you're going to be outdated. It's all about adaptability and finding opportunities where other people might oversee them.
So yeah, I'd 100% agree with that, Stuart. Like, that's exactly what I've been seeing with all of these COVID solutions. There's some that have broader application as well. So they're hitting a spike right now and they're going to continue to grow, but they still offer something of value in the future versus kind of a more of a trend item that could grow really quickly right now and is solving clearly a problem, but won't be venture grade or venture capital level investment if it's only serving that need in the near term.
So we've got a couple of questions here. I'll kind of see if I can sort them in a logical way. So we have one person here who's developed an app that has features similar to TikTok with about 30,000 downloads. They're trying to find out whether it's good time to go for investment. They do Android, iOS, and web. Now, is that the kind of traction people look for? Is 30,000 downloads in an app good enough to start talking to investors?
I think, sorry, I'll hop in first, quick off the draw. If that's okay with you guys. I think, as soon as you said the situation, 30,000 downloads sounds great, but you also said similar to TikTok. And so you just said there's a massive competitor that everyone knows worldwide, and you didn't outline any difference between the current product and that huge competitor. So I think from a VC or an investor standpoint, if you're just making the same thing as something that already exists with minor differences, that's not necessarily going to draw tons of investment potentially from VCs, because you'll be doing essentially a marketing play. You'll be trying to fight TikTok for users, and it's whoever spends the most marketing dollars wins. Unless you have a unique or new feature that's going to do something different, you might have a struggle really getting that core investment that you're looking for from VCs. But I'm not a VC, so maybe
Yeah,
the
no,
VCs.
I would agree with that, Alex, completely. Like, it's about the core value prop, it's about the IP, it's about the opportunity. Like, there's not enough to go on based on that description or those metrics. So it would have to be enough of its own entity.
And then we have another similar question, which I'm in the IT sector, and the question is, if I have a platform application that does not have traction at first and needs investment for consumer acquisition, do VCs usually interested in investment when you have a platform and you just need money for consumer acquisition?
I can also go again if you guys are willing to let me go first.
I'm happy to let you go.
Yeah, so I think in this scenario that if you have a product that you can at least get one customer to use and test your product out before, without needing tons of money to go in and get more customers, I think you might need to reassess your product. You can always get traction and find people to test it out, whether they're businesses or consumers. You can always, or you should be able to find people without needing to spend any money who are willing to test out and demonstrate some interest in whatever it is that you're trying to sell. Even if that means you need to give, you need to give it free to people or something like that, you should be able to get at least some demonstrable interest in whatever it is that you're trying to sell. And that will help show the VCs or whoever, or a crowdfunding platform, that you have that interest, and there are people who have tried your product and are willing to buy it. Even if you have free users, that's still better than having no users.
Anyone else?
I would just say, like, there's a couple stages too around this, right? So like a typical model would be going forward to friends and family round. If you don't have that, there's certainly grants, there's pitch competitions, there's tons of non-dilutive funding in the Canadian ecosystem, at least comparative to other countries. And then it would be more of a pre-seed angel stage fund round. And you can look at what VCs may invest and co-invest in those stages, including, Ontario Centers of Excellence, where I used to work. We would do 125 to 50K in earlier stage deals. And then many venture capitalists are operating in the series stages. There are some seed rounds and some seed funds in Canada, but overall it would be a later stage deal where you would have a lot more traction. So VC is just categorizing the different stages of investment and where it would make sense to engage for the most potential benefit and likelihood of success.
And I guess, if you're looking for customer acquisition and your cost, your CAC, your cost of acquisition, and your lifetime value, there's companies like Clearbank and whatnot that'll support you if it's a profitable venture. So that might be an interesting opportunity for people. So let's take a look. I'm going to jump back into these questions here. Alex, I've heard a lot of mixed thoughts on safes as an investment vehicle from an investor point of view and from an entrepreneur's point of view. What do you feel about safes as an investment vehicle?
Well, safes were started in the US. I think it was Y Combinator who got safes going a couple of years ago. And they are quite popular in the United States. They're definitely not as popular in Canada. And they can be useful if you have a price round coming in the future, because a safe essentially is taking investment and putting the value of that investment and the amount of ownership to be given out based on a future valuation that is yet to be determined. And so if you have a price round coming and essentially you want to use the safe to bridge the time in between, then it can be effective in that scenario. I think from both the investor and the entrepreneur's perspective, it can be challenging and can potentially clutter up future rounds. You don't know exactly how much you're giving away with the safe. And from the investor's perspective, you're not actually, because you don't have the shares yet, you have no control over the business legally at this point. And you technically don't have debt with the business either. And so it's hard to, if the business goes south, it's hard to register a claim in a future point if you're trying to sort of get your money out somehow during a bankruptcy proceeding. So that can definitely be challenging. Certainly with crowdfunding, equity crowdfunding specifically on Equivesto, we stay away from safes. We act as a price round. So a lot of companies coming and raising with us will use that to actually convert their safes into shares. And it's much easier just to issue straight common shares at that point. I think, if you're at a stage where you're pure ideation and you just need like 50 grand to build at least your demo or something like that, then maybe using a safe makes more sense, because how are you going to value like just pure projections and something that you don't even have like a wireframe for? But I think anything after that, you probably want to try to go for a price round as opposed to a safe.
Any other thoughts on safes?
They are unsafe.
For the investors, especially, yeah.
And that's, so as an investor, if you look at it as something and you see safe already on there, that's a little bit of a red flag. Okay. Just want everyone to understand that. So, Stuart, how long in general does an average investment from a VC, from the initial investor pitch through due diligence to the startups getting the money? I mean, I think people think they walk out the door with a check.
Yeah, like Dragon's Den, they pitch for like 3 minutes and then handshake deal and the money is transferred. No, that's not definitely not how it works in reality. And in fact, it doesn't even work like that in Dragon's Den, to be honest. I hear like 1% of everything they say yes to actually sees an investment. It's a grueling due diligence process. So yeah, in Canada, it's a lot slower than it is in the US. And that's, inherently because Canadians are very risk averse and always take time to make decisions and want to make sure they make the right decisions. It could take between 6 to 8 months for this process to happen, like in the best of times. That means the VC has the money, they're ready to deploy, they like what you're providing, there's no red flags, there's no issues. It just takes that long for them to basically think about it and do the research necessary, ask around to their friends, get other VC partners, strategic syndicate partners to go in on the deal with them. So yeah, I would say like around 6 to 8 months in the best of circumstances.
So we have another question here, and I'm going to try and summarize. They're building a tech company, more specifically mobile-based, and they're thinking of creative ways to show traction, and they need to raise about $70K to full development. So the question is, how creative is too creative for investors when proving your model?
Well, I would say there's different levels of traction that you can get. Always the best form is, of course, revenue. But failing that, you go down the list basically, and the further down the list you go, the less convincing it's going to be that people actually have demand for your product or service. So if you don't have revenue, then try to get a purchase order. And as we know, a purchase order is basically a contract where you provide the service and they're going to pay you later. So you need the money to provide the service or product, and then the VC will at least know that there's a legally binding contract that says the money's going to be coming in eventually. Failing a purchase order, the next line of defense is a letter of intent. And remember, if you're getting a letter of intent, it has to be from someone that actually has buying power. And usually the strength of the letter of intent will depend on the strength of the buyer. So let's say that you're selling products to Walmart, and Walmart obviously can have the potential to buy a lot of your products. You're going to want to make sure that you get an LOI from them if you can't get revenue or a purchase order. But you also want to make sure that that LOI is signed by someone who actually can make the procurement decision. And it's not just a greeter that you see when you walk into the retail store. And in terms of, getting creative beyond that, yes, for sure, do whatever you can. I always say that when an entrepreneur is pitching to a VC, think of it like a litigation lawyer in front of a jury or a judge. They have a case and they have their thesis, and that thesis is, my company is a good company to invest in because we'll survive in the short term, grow in the medium term, and then we'll have an eventual exit. And so as you're building up that case, you need to provide as much proof as possible. So if you have, weak proof on the traction front, it's better than nothing. So try to get as many users as you can, a large sample set. Someone said that they have an app where they had 30,000 downloads. That's definitely better than 0 downloads. The question I would ask, are those people who are downloading it, are they using it frequently? Did they pay for it when they downloaded it? Are they engaging? Are they giving positive reviews? All of that stuff kind of fits into the category of being creative to show traction. And I would say, yes, in that perspective, it's good to present that information to a VC.
Yeah, and apparently they keep putting the link in the chat room there. It's awesome.social, just for everybody wanted to check out that social media app. We've got a question for Stuart and Danielle. What, on average, historically, has been your average valuations of startups your companies have invested in?
Go ahead, Danielle.
Yeah, I've done a lot of pre-seed and seed stage deals between 3 million and 8 million. Valuations with like 125 to 50K investments.
Yeah, that's pretty much been the case with me, although probably a little bit scaled down further, like maybe between 2 million to 5 million. We're pretty early when we look to get involved with companies.
And how much can people raise in your platform, Alex?
Yeah, so companies can raise between 25,000 and 1.5 million on Equivesto, and we usually see valuations just like what Stuart was saying, between 2 and 5 million is usually where they sit. But companies can be much larger and raise. They're just going to obviously give up less equity on the platform, and so those companies would be raising more to sort of reward or invite in their communities, as opposed to being at a stage where they need the capital for growth. So I wouldn't include their valuation in the information I provide, because it would just skew it.
So the next question here is, where is the best, or it says, where is the best way to raise raise here in Canada from your perspective? So I'm not sure if that, where is the best place or what is the best way to raise. So I'll let either of you take that. We'll start with you, Danielle. Is it Halifax?
Damn it. I'd definitely, just for, factual sake, say Toronto. There's certainly the most convention of, investors and money. And second to that, I would say, you've got kind of little like hubs. You've got, what has been called Silicon Valley North, and they hate that, but, Kitchener-Waterloo to Toronto corridor. So that kind of region is where I've seen most of the investment activity in Canada. There's certainly a lot taking place on the West Coast in Vancouver, not to the same extent. And out here on the East, we've got about 5-6 funds. Panelists, Killick, Build Concrete, Sandpiper, and Island Capital Partners. So there's some benefits in looking regionally. Wherever you are is in some ways the best place, because if you're going elsewhere immediately, then people might ask, well, why wouldn't the people who know you the best invest in you? And so I would take a quick look around first before pushing further. But I also think when you do reach further past your kind of local region, obviously there's a lot of legitimacy in getting funding from Silicon Valley, and that can't be overlooked. And so you raise there, you go out there, there's a lot of legitimacy when you come back. So people do see that. So I think that's more the where question, and maybe someone wants to go with the what.
What's the best way to raise?
Okay, well, I'll jump in. I just want to add a little bit to the where, because there's something that I find entrepreneurs quite often overlook, and it's something that some of the companies in my portfolio had some huge success in terms of raising capital. Don't overlook rural areas like rural Ontario. There are people there. I mean, you don't think of it, but they're like multi-millionaires and billionaires living in farmlands or just the countryside that you wouldn't really think, because there's so much focus on Toronto. I mean, rightfully so. But if you really look at what your company is doing and what you're trying to solve, I would highly encourage you to explore avenues that people don't normally think of. Like VC is always the most common, but there's a lot to be said for angel investors. And when I talk about angel investors, I'm not even necessarily just talking about the stereotypical angel groups that people go to, but there's wealthy industry leaders within the industries that you're operating in that I think it would be worth reaching out to. Not like, first off, just to build a relationship, possibly as an advisor, but if you get them on board and interested in what you're doing, the likelihood and the potential of them investing in your company could be a lot higher. And then you have someone who's a legitimate equity partner in your business that has amazing contacts, amazing expertise that you might not be able to find if you just do the typical like angel group route or the typical VCs. I mean, I know I'm sounding a lot like I'm deterring people from pitching Danielle and myself, but I just want to. I don't like entrepreneurs getting kind of jaded or deflated when they hear of what VCs are looking for, and you think about your own company and you're thinking, okay, well, it doesn't sound like I'm a fit. That doesn't necessarily mean you won't be hugely successful building your business or finding capital elsewhere. And I think Alex's platform might be a great way to connect with those on the less typical investors that you could source capital from.
Yeah, it's funny that you mentioned that. We talked. I remember. It's been a while. A couple of years ago, we were talking to somebody at the CNE who was out of St. Catharines. They had a little tech hub out there, and it was an $8 million company. You and I were chatting with them, and who would have thought that? And I'm hearing little hubs out of Barrie and all their places that have some serious investment. So hit up your local entrepreneur, startup hub, Communitech, whatever happens to be in your local area, because they're the gateway to a lot of these resources that you wouldn't otherwise have access to.
Yeah, one thing I just add, not actually about equity crowdfunding, but about angel investors. If you're thinking about going for angels, a lot of the angel groups like to focus local. So just, when you're looking for places to pitch or people to reach out to, just do your research first and just look. They'll probably say on their website what their focus is, but there's no point in reaching out to, if you're in one area, there's no point in reaching out to an angel investor group in another area when their website says specifically, we only fund businesses from our city or our geographic region. And so you want to make sure that if you are reaching out, that it is to people who are, interested in sort of looking for outreach.
So I think we're almost out of time. So we'll do one last roundtable. Any parting words for our audience? And if people want to find out more, where will they contact you, Danielle?
Yeah, I mean, I'd just like to echo what they were saying. Like, I just have a quick anecdote to say. When I was raising funding for my clean tech startup, I had incorporated in Bruce Power, or near Bruce Power in Grey County. So I actually had a random angel network called Grey County Angels that I'd never heard of calling me up and being like, we really want to invest in you because we're out here. So you never know who's out there. And I really think kind of looking under new rocks and not only thinking innovatively about your company, but thinking innovatively of the way that you build your company, the way that you raise capital for your company. Like, also don't take no for an answer. Don't get discouraged. Have a big pipeline of all potential investment vehicles and funding vehicles, and see where the fit is. So overall, I would say, Sandpiper is very specifically focused on supporting women entrepreneurs. So that would be kind of the companies that would be most relevant. And we do have an intake form on our website, sandpiper.pc.
Great, thank you. And Stuart, if any parting words, and if people want to find out more about you and Pycap Venture Partners?
Yeah, sure. Just parting words. I'll just reiterate something I said before, just because I wanted to sink in, is just to really focus on your business model. I mean, your first way to raise money for your business should be through revenue. Like, just try to sell whatever, even if you don't have your product finished and you need money to take it to market. There's other ways to generate revenue, like consulting, bootstrapping, doing something that's related to your core business that'll help you get there and build a network. Like, all of that stuff speaks volumes to potential investors, and in terms of how you were able to make ends meet. Happy to have a chat with whomever would like to. If you want to get in contact with myself or my team, please email us at info@pycap.ca. I'll put the okay, hold on. Do you want to put that in the chat?
Yeah, I'll do that. info@pycap.ca.
Yeah, and you can also put our website there, which is just pycap.ca as well.
Great. And I'll follow up with the links in the email afterwards tomorrow, the next day. Alex, over to you. Any parting words, and where can people find out more?
Yeah, just sort of echoing what Danielle and Stuart were saying. There's lots of different ways to raise capital. Obviously, VCs and equity crowdfunding are two examples, but there's lots of different ways. And part of what makes everyone good at being entrepreneurs and successful is the fact that you're all looking for new ways to approach things. So make sure you apply that also to the way that you go out to raise capital, and not just the way you're approaching the way that your company does business. There's always going to be a way to get the capital you need to find and to fund your business if you continue to think outside the box and stay focused. And yeah, make sure to don't neglect to work on building a community, because with equity crowdfunding, one of the major factors that leads to success is actually having a strong, developed community that you are sort of ready to potentially invite to become investors. So all throughout the journey of building your technology or your business, whatever it is you're working on, don't neglect building that social media following, building an email list, building that sort of small community around you, because that will pay you dividends in the future, whether you do equity crowdfunding or not. If you do want to consider equity crowdfunding, you can check us out at equivesto.com or on any of the social medias at Equivesto.
Yeah, and we have upcoming one-on-one people can book with you on November 20th, but I'll send that link out in the email for everybody. Thanks, everyone, for joining us. Thanks for all the questions and the interactivity from the audience. And again, thank you, Stuart, Danielle, and Alex, for taking the time today and sharing your knowledge and wisdom with us.
Great. Thanks, Craig.
Thank you, Craig.